Mrs. Retnawitawati, MSc Ph.D. The time is yours.
Yeah. Thank you, Pak Taufik. Assalamualaikum warahmatullahi wabarakatuh. Welcome to Dr. Lee from Tamkang University. This is part of our cooperation as partner universities between Tamkang University and Universitas Muhammadiyah Yogyakarta. So we are very thankful that you can do it. You can fulfill our request, our invitation to have a guest lecture. It's already long time ago, our cooperation between TKU and UMY, when the president of the university come to our campus and sign the MOU. And then Prodi, or the Department of Management, is one of the most active to fulfill the cooperation between this university. There are some not only guest lecture, but visiting professor, Professor Liu, come several times and also become keynote speaker and also guest lecturing. And now Dr. Lee come as guest lecturer. So we are very thankful. And this topic is very interesting, both to us and students. Hopefully later students can use this opportunity to discuss with Dr. Lee, that Dr. Lee already gave his time, his valuable time to us. So we could, the students could discuss it more, yeah, and explore the how Taiwan practice in this banking area or other. Again, thank you, and please, Pak Taufik, the time is yours. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you for Mrs. Retnawitawati for your speech. And the next opening remark is from our Director of International Program on Business and Management to Mrs. Indah Fatmawati. The time is yours.
Pak Taufik, we can directly skip to the main agenda.
Oh, okay. Maybe we can move to the main agenda for today. Maybe we can enter now. And okay, before we move to the next agenda, is our main agenda is the discussion. As we know that we will talking about the understanding of the risk management, and maybe we can specifically talking about in the banking sector. I think it's very interesting topic because we know that the banking sector is quite critical, especially in the risk management. So I would like to say welcome to Professor Lee. Okay, maybe we can start now about the discussion. For Professor Lee, the time is yours.
Okay, thank you, Professor Taufik. And also thank you, Professor Wadi, your invitation. Let me have the chance to share something about the risk. Okay, and also welcome all the students. Welcome to today's class. Okay, today you are here, it means now you are safe. Okay, so I think since the COVID-19 epidemic, there are many people passed away in this time. Okay, but now we still safe. We thank our God. Okay, so now suppose now I can start my today's class.
Yeah.
Okay.
Yeah.
Okay, I like try. Okay, so now can you see my screen?
Yeah, I can see
Yes,
clearly.
sir.
Yeah.
Okay. Give me a second.
Maybe while we wait, Professor Lee, we're preparing for all of the students or the participant that maybe have the question, and you can write your question into the Zoom text, the Zoom message, or maybe you can directly ask the question in Q&A session. Thank you.
Okay, here. Okay, now I think it's okay.
Yes.
Okay, as the Professor Tofik introduced, I'm Lee from Tamkang University in Taiwan, and it's my honor have the chance to share something here. Okay, so I think today I'm going to introduce something about financial risk. Okay, and as we know now, if you like to know what is a financial risk, I think it's easy. You can search, you can Google it, and you will find something. Maybe. Okay. You will find some similar definition from the internet. Okay, for example, you can see here, risk is defined in financial terms. The chance that an outcome or investment actual gains will differ from an expected outcome or return. Okay, but in fact, the definition for me is not so clear. Okay, I think for many readers, they may have the same feeling. Okay, not just this one, also including from some other definition, you will find, yeah, every word is very clear, but put them together, the meaning, it seems not so clear. Okay, but so here, if I use one term to explain risk, maybe not just financial risk, it means uncertainty. Uncertainty. Okay, so when you face uncertainty, we say we face risk. Okay, so here I have I just put a pinball game in Taiwan. You are very easy to find on the PPT. You can see a pinball table here. Okay, so based on this game, we know in the beginning. Okay, give me a second. Okay, in this game, you will find, normally you will put a ball here, okay, and you just shoot, the ball will start from here, okay, and finally the ball drop down from here, okay. Every time it may hit a pin, okay. After he hit a pin, there are two possibilities, okay. It may fall in from the right hand side or fall in from the left hand side, okay. And it's just like a stock price or some other financial asset price. Okay, every time, every second, every minute, the price may be up. Here you can see, maybe you can define here's up, and or the price may be down, So every time you just drop from here, and every time you hit a pin, okay, and after hit the pin, the ball may drop from the right hand side or from the left hand side. Right hand side, it means up, and the left hand side means down. And finally, the ball will drop into a certain column, maybe here, maybe here, okay, maybe here. Okay, suppose we have a very big pinball, very big one, okay, and pinball table, we have a very pinball table, okay, so we try just hit many the ball in the pinball table, and finally you'll find here there are some ball here, okay, and also here there are some ball here also, and finally you will get a shape just like this, just like this. Okay, this is kind of distribution, the kind of distribution. Okay, then what is the risk? We say, okay, if the level of dispersion is wider, we will say is risky. Okay, it means the uncertainty is higher. What is the meaning? Okay, let's see here. On the left-hand side, we have a chart here. Okay, suppose now the mean price, maybe the middle one is about 100. Suppose maybe the price is $100. Okay, and the low one, maybe if I just calculate the probability in this area, maybe it's about 95%. Here it's about 95%. And the left lower limit, maybe here it's about 80. And the right hand side here, maybe 120. So it means I have 95% confidence. Okay, and the price was between $80 and $120, between $80 and $120. And we see the other one here. Okay, also maybe the middle is also $100. Okay, but if I like to cover 95%, okay, 95% here, also 95% here. Okay, but we will find the lower limit, the lower limit maybe, okay, is from maybe 70, and the upper limit, okay, maybe it's 130. It means I have 95%. The price will falling into between 70 and 130. Okay, so we can tell on the right hand side, the price is wider because the price may be from 70 to 130. Okay, and the left hand side is only from 80 to 120 under the same probability. So we will say, okay, the right hand side situation is risky. It has a higher risk. Okay, so based on this, okay, we know most of the time we can base on the concept to calculate their risk, because maybe you base on one point, you can say, okay, it seems risky, okay, but I need more evidence. Okay, so we need some way to help us to quantify the risk. Okay, because when you tell me, okay, this stock is higher risk, okay, but how high? You have to give me more. Okay, you have to give me more detail. Okay, so normally we will use some way to calculate the risk. Okay, the first one, volatility. I think most of students have studied the way in your first year in university. Okay, because volatility means the variance or the standard deviation. Okay, so based on the variance or the standard deviation, we can calculate, we can define which one is risky. Okay, so normally this is a easy way to calculate about the risk. Okay, and the second method, okay, we easy to see is CAPM. Okay, capital asset pricing model. Okay, capital asset pricing model. I think in the future, maybe in the next year, okay, maybe you will meet the theory, okay, in financial management or in investment. Okay, maybe in the second year you have learned, but I'm not sure. In Taiwan, most of the students they will learn possible the second or third year. Okay, they will learn about the investment or financial management. Okay, in this method, okay, it's a little bit different from the volatility method. Okay, CAPM is just based on, okay, I like to know if you should get as much premium as you take on the extra risk. Okay, it means if you take on more risk, you should expect to take more earning in the future. Okay, so based on this, some research they just find, okay, based on this, we will find we can start from the risk-free. In this formula, RF means risk-free. Okay, if you don't like to take any risk, you can purchase maybe a government bond. Okay, normally a government bond is risk-free. Okay, they will not default in the future. Normally, probably. Okay, so based on this, if you invest your money on some stock or some bonds, okay, you are going to take some risk. Okay, so if you purchase some now it's okay, the sound. Can you hear me?
Yeah,
It seems okay.
Yes.
Okay.
Yes.
Okay. Okay. So if you purchase some shares or some bonds from individual, from private company, okay, it means in the future they may default. Okay, nobody can guarantee. Okay, that. Okay, so you are going to take more risk. Okay, so normally you are based on how much risk you have to take on to design how much premium, or more clear, we say risk premium, how much risk premium you will require from the company. Okay, so this formula is based on this. But I think in this week, we don't have time to discuss about CAPM. Okay, if next week we have time, maybe in next week, we are going to discuss about CAPM. Okay, and the other way, VAR, VAR, okay, value at risk. Okay, this terms is similar to variance, because most of the time when we're talking about variance, we usually use VAR. Okay, but the R is a small one. Okay, when we're talking about volatility, here VAR, the R is risk, Okay, so you will see we use the capital R. Okay, and I think VAR is very different from volatility or CAPM, but basically value at risk is based on volatility to calculate. In value at risk, it will tell us, okay, in the next maybe 2 or 3 weeks, okay, you may lose maybe $1 million at the most. Okay, $1 million at the most in maybe 95%. It means in the next three weeks, okay, you only have 5%. You may lose more than 1 million. Okay, so this is VAR. Okay, so you will compare these 3 methods. First one, volatility. We use the variance. You just calculate how the return, dispersion. Okay, you just calculate the dispersion. Okay, and the CAPM, capital asset pricing model, it can tell you if you take 1 unit risk and how much you should require from the company. Okay, and the third way, okay, it just gives you the probability you may lose and how much at the most. Okay, and also VAR, we are not going to discuss this week. Okay, so in today, we are going to discuss more about volatility. Okay, volatility. Okay, so, okay, and now I'd like to share why we can use variance or standard deviation to measure the risk. Okay, just like I say, yeah, because the uncertainty, if the uncertainty is higher, it means the risk is higher. Okay, so based on this, we will see here again. Okay, so you can see here. I do believe all the students, you have studied statistics and you probably already know the formula here, okay, about variance, okay. But we see the formula. In fact, it means something, okay. It means something, okay. Because just like I say, the variance, it just helps us to measure the volatility, okay, to measure the dispersion, okay, dispersion. Okay, so we just set a standard. The standard is the mean value, X bar. X bar, the mean value, is just add up all the samples and divided by the sample size. Okay, here. Okay, so this is the sample mean, the sample mean. And maybe the first one, people is here, this is X1. And the X2, the observation 2 is here. Okay, and the 3 maybe it's here. And the 4 maybe is here. Okay, maybe it's here. Okay, so when the point is above the mean value, it means the value is higher than the mean value. Okay, so because I like to know that this dispersion. Okay, so in the easy way, I can easily to measure the distance from observation to the mean value. So here is the distance. The distance. Okay, you can also see here the observation value subtract the mean value. This is the distance. This is the distance. Okay, and the second point also you can calculate. Okay, just based on this is the second point, the mean value. Okay, the mean value. Okay, so if I like to know the distance for all the samples, from the samples to the mean value, is the easy way. Okay, I can easily just add up all the pointer. So I can see the xi minus the x bar here, x up. Okay, based on this, you can roughly get all the distance. But there's a problem. There's a problem because you can find some of the point is above the mean value, but some is under the mean value. Okay, so it means if the observation is high, is above the mean value, it means this is positive. Okay, but under the mean value, it means this is negative. Negative. So if you just add up all the points, finally you can get 0. You can get 0. Okay, I think this is easy to prove. Okay, because you will find based on this, you can get, we can rewrite it, become xi and summation x bar. Okay, and you can find here this one, because x bar equals to the summation xi divided by n. Okay, so if just based on this, you will find x bar. Okay, well, if based on here, I have too much things. Okay, just give me, I try to cut out something here. I need some space. Okay, so based on this, okay, you will get, okay, n times x bar equal to summation x I. Okay, and you can see here, if we just add the x bar n times, finally you can get u are equal to n times x bar. They are the same. They are the same. Okay, sorry, this is negative. Yeah, this is negative. Okay, so if we easy to get, just use the summation xi minus x bar, you will get 0. You will get 0. Okay, so based on this, we cannot just easily to add up all the point. Okay, so for result this problem, we easily, okay, then we just put a square here. Okay. Okay, here, xi, x bar. So we just put a square here. Okay, after you put a square, okay, now all the points, all the distance are positive. But the next problem is, now suppose I have the 10 samples and the other one I have 1,000 samples. Okay, 1,000 samples and 10 samples. If you based on these two different sample size, you will find probably most of the time, if you just add the distance, and then you will find the value from 1,000 from the big sample size, they will get a big number, So for this reason, so easily, okay, I just based on the sample size, then I just divide by the sample size. Okay, then now we can compare their volatility. So that's why we use this formula to help us to calculate the volatility. It's based on this reason. Okay, so I think the formula you may also still remember, but why we based on this formula to calculate sigma? Maybe you don't know. Okay, so normally it's based on this reason. Okay, let's come back here. Okay, so why we use the variance to calculate the risk? Okay, because use the variance, we can easy to calculate about the volatility. We can calculate about the dispersion. Okay, we can easy to calculate the dispersion. Okay. Okay, but I think based on, I also teach statistics. So as I know, in most of the textbook, normally when we calculate about a standard deviation, or when you calculate a standard deviation, just based on this formula, this one. Okay, but for some maybe financial problem, sometimes we don't use a single point. Okay, sometimes we will give you different information. Okay, for example here, okay, suppose now you are like to invest your money into the market. Okay, and now we have three different situations. The situation 3, okay, suppose no any COVID-19 epidemic, okay, no any epidemic, okay, you probably can get the return 30%. Okay, suppose the situation 3 is this, no any epidemic, okay, so you can get 30% return. Okay, and the other one, situation 2, okay, maybe, okay, probably we have the epidemic, but not serious, maybe not serious. Okay, but in this situation, because we already have the epidemic, okay, maybe you are going to lose 5%. Okay, and the situation 1, it means, okay, the epidemic is very serious. Okay, so you are going to lose 10%, not 10%. Okay, so based on this, we can still calculate about the standard deviation or the variance. Okay, but the concept is totally the same, just like before. Okay, but now here again, why we just divide by n, because we think every point the probability is the same. So if you have 100 sample, you have 100 sample points. Okay, it means every point 1%. So it just easily 1 divided by 100. Okay, so everyone is the same, so it's easy. Okay, but for this one, I just give you 3 different situations. Okay, and everyone I just give you different return. Okay, so normally you can base on the information to calculate the expected return. Okay, based on the probability and based on, suppose now I give you the probability. Situation 1 is 20%, situation 2 is 30%, and the situation 3 is 50%. Okay, and based on this, okay, we can calculate about the sigma, also the variance. Okay, so based on this, we will find, okay, I just give you another formula, but in fact they are the same thing. Okay, but normally we like to use this format. Okay, so you can see based on this, I'm going to calculate the expectation of R as a return minus the expected return. Expected return here, okay, maybe I just take this page out. Okay, here, this one, it means I just based on the return minus 10 and times the probability. I just times these 2 numbers. Okay, and here the R, this one, The R is found. Okay, sorry. Where? Okay, sorry. This R is mean the total mean. Sorry, is based on this one plus the next one is 5% and 30 also, and the 30% is 50% here, and add up. You can get the expected return. Okay, and the R is from this one. Okay, this is our R. Okay, and the second one, the third one. Okay, so in this case, you have to calculate 3 times. Okay, so if you're unfamiliar about this part, maybe you can check some statistics textbook, okay, including the previous, okay, or maybe you can check some investment book or financial book. Okay, they will give you about this part. Okay, and finally, you can get the variance. This is normally way we calculate about investment standard deviation. Okay, normally will give you maybe the probability. Okay, in different situations. Okay. Okay, so based on this, we'll find we can get the sigma square. The variance is about 3.45%. Okay, 3.5%. Okay. Okay, so now I have a question for you. Okay, maybe you can just think about this question. Okay, now suppose you already graduated from university. Okay, and you just work in a bank. Okay, and so you suppose now you're in charge of loan business. Okay, you in charge of loan business, and suppose now your professor, one of your professor, and your classmate come to you for a loan. Okay, because they are going to purchase a house. Okay, so they like to make a loan. They like to borrow the money from your bank. Let's say maybe $5 million. Okay, they like to borrow $5 million from your bank. Okay, my question is, who you should charge more interest? Okay, so your professor and your classmate, Okay, without personal emotional factors. Okay, you cannot tell me because the classmate is your best friend. So I should charge my best friend lower risk. Okay, if you do it, maybe you will lose your job. Okay, and you cannot also say, oh, because the professor is very nice, he also always give me a very high score, so I can give you a low interest rate. Okay, you cannot do it. You cannot give me the risk. You cannot tell your boss because the professor is very nice, so I'm going to give the professor a lower interest rate. Okay, you cannot do this. Okay, so maybe you will think, okay, because the professor, his job seems stable compared to your classmate, because your classmate just graduated from university, maybe you just got her job maybe 6 months. Okay, so you are worried about, okay, in the following maybe 5 or 10 years before the maturity date, okay, you to believe maybe you have more than 90%, you think the professor, your professor, okay, they will repay the principal and the interest normally. You to believe that, okay, your professor can repay the principal and interest normally. Okay, but for your classmate, you will think about it. You think maybe it just got the job 6 months, and it's maybe another very famous, maybe another very big company. Okay, maybe probably couple months later, your classmate will lose her or his job. Okay, who knows? Okay, so you worry about this. Okay, and you think the probability is pretty high. Okay, it means maybe you only have 60% before the maturity. Your classmate can you have more than 40%. Your classmate may not be able to repay the principal and the interest normally. Okay, you will worry about this. Okay, maybe you cannot repay the principal and the interest. So based on this, you will think, okay, I should charge the classmate higher. Okay, because you probably default in the future. Okay, but for the professor, okay, his job is stable. Okay, and in the future, I do believe he can repay the principal and the interest. So I can give the professor a lower interest rate. Okay, interest rate. If you think this, I think it's pretty correct. Okay, because basically, when you price or when you charge for any financial asset, normally or basically you are based on risk, Okay, so you are based on the different risk to charge. Okay, so because your classmate has a higher risk, so you will think about, I have to charge the classmate higher. Okay, because you need something to compensate because you take on the risk. Okay, to remember, we just said, if I ask you to take on more risk, and you will require higher return. Okay, so if you work for a bank, it means you will require the customer to pay more interest. Okay, so this is the what we said. Okay, and now my second question. Okay, which investment target should have a higher expected return? Suppose now we have two options, stock and a bond. Okay, now suppose in the same company or a company A, they just provide, they are going to issue some stocks and also bonds. Okay, and you are the investor, then which one should provide a higher return? Okay, I mean expected return. Okay, expected return. Okay, think about. Okay, let's come back. I think this is easy. Normally, you just compare about risk. Okay, if you know which one is risky, and you will know who should provide a higher expected return. Okay, and basically, stock, when you purchase stock, it means you just invest in some equity. Okay, and bond is kind of liability. And as I know, okay, and I do believe most of you have studied accounting. Okay, and based on the normal equation, the accounting equation, we know asset equal to equity plus liability. Okay, and now I'd like to ask you, okay, if today the company, maybe the board of directors, they just decide, okay, we are going to close the business. Okay, we are going to liquidation all the business. Okay, so we just sell all the assets. We sell all the assets and to take the money back. Okay, so in the beginning, in the first, you have to repay the money to the creditor. Okay, to the creditors. Okay, so all the creditors, they can get the money back before the shareholder. So it means, okay, if the company is going to bankrupt, okay, so they just liquidate all the assets. Okay, they just sell all the assets in the market and to get the money back. Okay, so in the first, they have to repay all the liabilities. Okay, so they just repay the money to the creditors. Okay, so this is the first. And after they return the money to the creditors, if there are any debt, they will return the money to the shareholder. Okay, the shareholder. Okay, so it means if the company is going to liquidate, okay, the creditors, they can get the money in the first, and then the shareholders. And from the other viewpoint, as we know, most of the bank, they have a coupon. Okay, they have a coupon. Okay, it means maybe every year the company will pay you pay to the bondholder about 5% or 3%, no matter the company make money or not. Okay, it doesn't matter. Because a bond is a kind of contract. When you issue a bond, you just sign the contract with the bondholder. You are going to pay maybe 5% or 6% every year. Okay, so no matter the business make money or not, you have to pay the interest every year. Okay, so but let's see about the stock. If you purchase stock, if you purchase stock, the company, they don't have the responsibility to pay you dividend every year. Okay, if the company make money and then they were going to pay you dividend, okay, they will pay dividend. Okay, if the company didn't make any money, they couldn't pay any dividend. Okay, so there are some uncertainty. Okay, but for the liability for the bondholders, okay, you are pretty sure every year you can get 5%, and at the maturity you can get your principal back. Okay, on this the company bankrupt. Yeah, if the company bankrupt, and probably you can take a part of your invest. Okay, if the bondholder can only take a part of their investment, it means the shareholder cannot take anything. Okay, so based on this, we know, okay, the invest on the stock or on the bond. Okay, the stock with a higher risk. So based on this, if you are an investor, you are required. If you like me to invest on the stock, and the stock must provide a higher expected return. Okay, and do remember and notice here, expected is not a certain return. Okay, and this is interesting. What is expected? Maybe you heard the term a lot. Okay, because when we calculate the mean value, we also use the expected value. Expected return, it also means the mean return. It also means the mean return. Okay, so it means, for example, now I tell you the company A. Okay, now we have a company A. Okay, the bond, they just provide about 5%. This is for the bond. Okay, and for the stock, okay, the expected return is 8%. What does it mean, 8%? Okay, it means if after you invest on the stock, you can get 8% back end of the year? No. Okay, it doesn't mean you can get 8% back in the first year. Then how about the second year? No. Here we said it expect return. It means in this year, maybe you can only get 2%. Okay, but in the next year, maybe you can get 12%. In the next year, maybe you can get only 6%. But for a long term, maybe if you invest on the stock, maybe let's say 30 years, and normally you can get the average return 8%. Okay, but for every year you will find maybe 2. Oh, sorry. For every year, maybe you will find 2%, 12%, 6%, or maybe 9%. Okay, and every year you can get a different return. Okay, but for a long term, that just like I say, 20 or 30 years, if you calculate the average, normally you can get 8%. It's about 8%. Okay, so why some people tell you if you like to invest in the bond, in the stock market, maybe you can hold the stock for a long term. Okay, because in short term, if you are unlucky, maybe after you invest and you just get 2%. Yeah, if you are unlucky. Okay, if you are lucky, maybe you can get 12% in 1 year. Okay, so because just like we calculate about volatility, you will find, okay, for the bond, every year you can get 5%. But for the stock, you can see every year, sometimes lower than 8%, and sometimes higher than 8%. And roughly the mean value is 8%. Is 8%. Okay, I think the expected return is a very important concept. Okay. Okay, so just like we already mentioned, okay, I like you to take on more risk, and I have to provide higher expected return. Okay, so it means risk and return, they have a trade-off relationship. Okay, so the risk return trade-off states that the potential returns rises with an increase in risk. Okay, so here the same, the potential return, it also means the expected return. It's not mean right now you can get. It just means it probably you have a chance you can get. Okay, so if you take more risk, okay, it means I have to provide a higher potential return. Okay, otherwise you are not going to purchase, okay, the stock. Okay, so using this principle, individual associate high level of the uncertainty with no potential returns, and high levels of uncertainty or risk with higher potential returns. Okay, just like in short, we can say high risk, high return, and low risk, low return. And again, here the return, it means expect return. Okay, it just say if you invest the under asset for long term, roughly you can get a higher return compared to some other low risk uncertainty asset, underlying asset. Okay. Okay, so next, maybe you heard about this. Don't put your eggs in a basket. Okay, because when you fall down your basket, maybe you could break all the eggs. Okay, so if you put your eggs in different baskets, maybe let's say 10 baskets. Okay, if you fall for one, okay, maybe you just lost 1%. And if you just put your eggs in 100 baskets, okay, if you fall one, and maybe you just break one egg in the one egg in the basket, you may lose maybe 1%. Okay, so I think you may heard about the sentence. Okay, but here I like to give you more detail about, maybe I can use some mathematics to explain this. Okay, in risk management, we use a lot of mathematics. Okay, because sometimes maybe I can use words to explain it. Okay, but sometimes you will feel it's abstract, it's not clear. Okay, so most of the time we like to use some mathematics to explain it. Okay, so here I just like to use the mathematics to explain it. You don't have to know the detail, but if you are interested, I suggest you to study this part. I think this is not so hard. Normally we just base on until this, we just base on some statistics concept. Okay, so now suppose we have two investments with return R1 and R2. Okay, so the first one, the return, in the invest one, you may get the return 1, and the other one we can get the return 2. Okay, and the return from putting a proportion W1 of our money in the first investment and a proportion W2. Okay, W2 equal to the 1 minus W1. Okay, it means you just put all your money in these two investments. Okay, proportion 1 and proportion 2. You add up proportion 1 and proportion 2, you will be 100%. 100%. Okay, so normally you can base on, we calculate expected return or the expected value to calculate about the portfolio expected return. Okay, so we can base on the first one is R1, the first two. Okay. Okay, the first one is R1 here. Okay, and we just put about 31% of your money on the first one. Okay, and the second two return is R2. Okay, I think the more precisely we should write this one to be expect R2. Okay, unless, okay, unless this is a bond. If you invest a bond, probably you can use R2. Otherwise, if it's a stock, maybe you have to use this one. But I just simplify. Okay, I just simplify the formula, so I just use R1 and R2. Okay, and the second one is the proportion is W2. Okay, and just like I say, W1 plus W2 will equal to 1. It means 100%. 100%. Okay, and roughly we can base on the statistics to calculate about the variance. Here, the variance you can see here, just like I say, here the R is a small r. Okay, it's not a capital R. Okay, it means the variance. Okay, so the variance here. Okay, you are based on this formula. I'm not going to discuss the formula detail here. Okay. So if you are interested, you can come back to check your statistic. Okay, so normally you can get, okay, if I take not just one asset, I just put all of my money into two investments. Okay, and finally I can get the variance of the portfolio is W1 square times sigma 1 square plus the W2 square, sigma 2 square, and plus, okay, plus 2 times the W1, W2, and the other one here is the covariance, and the covariance. Okay, and the covariance here is important. The covariance, if the covariance divided by the standard deviation of the individual investment, okay, you can get the coefficient, the correlation, okay, the correlation of coefficients. Okay, so this is the coefficient correlation. Okay, so you can get the covariance. We can rewrite just like the rho times the sigma 1 sigma 2. Okay, sigma 2. Okay, so here I am going to give you the first example here. Okay, you can see. Okay, suppose now there are two investments, and the expected return from the investment one is 10%. Okay, the second one is 15%. Okay, and the standard deviation of the return from the first one is the 16%, and the second one is 24%. Okay, and now suppose we know the correlation between returns is 0.2. Okay, so now we already have all the information. Okay, so we have some possibilities here. Okay, for the first one, maybe, okay, maybe you can just put all your money. You can just put all your money in the first investment. So I can see here. Let me see here. If you just put all, oh, sorry, second investment. Okay, if you just put all your money on the second investment, okay, and you can get the return just from the second The second return is 15%. You can see here. Okay, and the standard deviation is 24 here. Okay, so I can get, okay, the return is 15% and the standard deviation is 24%. Okay, and if you put all your money on the first investment, okay, first one, okay, you can see here, 10% here, 10%. And the standard deviation is 16% here. Okay, you just put all your money on the first investment. Okay, and now we just consider, okay, we're not going to put all the money on a single investment. Okay, we just, for example, here, we just put 20% on the first one and 80% on the second two. Okay, and you will get, okay, based on the formula before, okay, the weight one times the return one plus the second two, okay, times the R2. Okay, so you can get this one. You can get this one. Okay, so finally, if you put 20% on the first one investment and 80% on the second investment, you can get the expected return. It's about 14%. 14%. Okay, you will see, okay, when you put more on the second one, okay, because it and the return will goes down a little bit, as you can see here, okay, because the first one, if the second one provided the investment, the return is 15%. This is the second one, but the first one can provide the expected return is about 10%. If you just put some money from the second one, so the return will going to reduce a little bit. Yeah, it makes sense. It makes sense. Okay, so the return from the 15% return to 14%. Okay, but you can see here the risk, because we use the standard deviation to measure the risk. The risk reduced almost 4%. It reduced from 24 to 20.09%. Okay, from 24 to 20. Okay, so it reduced about 20%. It's just like we mentioned. Okay, if you like to earn more, and you have to take on more risk. Okay, or if ask me to take more risk, and then you have to give me more return, expected return. Okay, so in this case, you can see when you reduce your expected return, okay, you also reduce the risk, okay, and from the other, we can see here 40%. If we invest 40% on the first investment, okay, and 60% on the second one, okay, the expected return will reduce also 1%, okay, and the standard deviation return more than 3%, okay, more than 3%. But you can see the standard deviation keeping reduced, okay, and 40 and 60 and 40% you will see also, okay. So based on this, we will find if we increase the shares on the first one, okay, then the expected return will reduce from 15% to 10%, okay. So 10% means you just put all your money on the first investment, okay. But there is an interesting, maybe you already find, okay, here, if you put all the money on the first investment, okay, you can only earn 10%, okay, and the risk is about 16%. But if you reduce a little bit, I mean, here 20%, okay, you can see here 20% here. You just reduce about 20%, okay, and just put a 20% on the second investment, okay. You will see from here, okay, the expected return increased 1%, and sorry, the standard deviation also returned more than 1%. 1%. Okay, this is kind of diversification effect. Okay, it means if you don't put all your eggs in a basket, okay, normally you can reduce the risk, and in a certain level, it not just reduce the risk, you can also increase your expected return. Okay, so you can see, in fact, if you put all your money on the first investment, it's not a wise decision. Okay, because if you reduce a little bit, you just take some money from the invest in the first one investment, you can increase the expected return and also reduce the standard deviation. Okay, but if you increase more, okay, for example, to here 60 to 40, okay, okay, here is 14, but if you increase the share more on the second one, okay, this is the second one, let's say to the 40%, and you will find, okay, yeah, you can increase the expected return 1%, but you have to take more risk, okay. So this can show you, okay, if you just invest in a single investment, it may be not a wise decision. Okay, so here, if you can put your money in different investment, it may reduce your standard deviation. I mean, reduce the risk. And meanwhile, you can increase a little bit your expected return. Okay. Okay, so here I just give you, okay, I just draw the X. Okay, maybe I just take picture. Okay, here. Is the standard deviation, okay, or risk. Okay, sorry. And here is the ratio or the proportion. Okay, when you put money in, this is for the first investment. Okay, from 20%, 40%, 60, 80, and 100%. Okay, if you put 0% on the first investment, it means you just put all your money in the second one. Okay, second one. So here, this point is here. Okay, and this one, you just put all your money in on the first investment. This is here. Okay, but if you just mix them, okay, I mean you just put some invest one and some invest two. Okay, normally you can reduce, okay, your risk. Okay, you can see you can reduce the risk. Okay, but it cannot keep reduced all the time. Okay, at some level, okay, you are increased. Okay, and here there is an interesting thing I have to say. Okay, normally if the correlation is not one, okay, normally you can reduce the standard deviation by combine two different investments. Okay, and if the correlation is negative, you can get a higher effect. I mean the diversification effect. Okay, so here I give you another example. Okay, they're talking about, okay, now suppose the correlation is -2. Here the correlation means rho. Okay, we calculated before. Okay, so if the correlation is -2. Okay, you will find you can reduce the standard deviation more. Okay, the top one, the red correlation is 0.2. Okay, and the lower one correlation is negative 0.2 or 0.2. Okay, so when you increase the proportion on first one, okay, let's say 20%. Here you can reduce the standard deviation to 20. But let's see if the correlation is -2. Here, -2, the correlation is -2. Okay, the standard deviation will reduce to 18%, almost 19. Okay, but you can compare the difference. Compare the difference. Okay, the expected return is the same, 14. Okay, but the standard deviation, the risk is lower than before. Okay, here only almost 19%. Okay, you can see the other one, 14, 16, 12, and 14. Okay, and 12 and 14. Okay, so you can see, except you put all the money on the first investment or all the money on the second investment, compared to other point, you will see if the correlation is negative, you can reduce the standard deviation more. So you can see the curve here. This curve is just based on the raw. Oh, sorry. Okay, here. Okay. Here, the rho is equal to -2. And this one, the rho is equal to not 2, 0.2, -0.2. And this one is 0.2. So positive 0.2. Okay, so it means if the correlation is smaller, you will get a smaller curve. Okay, you can get a small curve. Okay, so based on this, I'm going to give you more. Okay, here. Okay, let's turn back to the formula. Before I give you how to calculate the sigma and the covariance. Okay, so here. Okay, this is the variance, the formula. Okay, you can easily find the formula from many financial or investment book. Okay, or some statistic book you can also find. Okay, and this is rho. Okay, rho we can write is covariance divided by the individual standard deviation. Okay, and here you can see, based on this, suppose we just discuss about 3 special cases. The first one, now suppose the coefficient is 1. Okay, so it means now suppose I let's just get this is 1. Okay, if this is 1, we can get the sigma will equal to here, because this is 1. This is the rho is 1. So finally you can get W squared sigma 1 squared plus 2 times W1, W2, and sigma 1, sigma 2. Okay, and based on this, I think use your junior high school mathematics skill, you will find this can be rearranged just like this one. Okay, you can rewrite the formula to be W1 times sigma 1 plus W2 sigma 2. And in fact, this one is kind of weighting average. It's a kind of weighting average. It means you just use the weight, the W to be the weight, and calculate the mean value. So we call it weighting mean average. Okay, so if the correlation is 1, you cannot reduce. Okay, maybe I can, it's not a pretty correct. Okay, it just based on this. Okay, if I back to, okay, let's come back to here. Okay, if the correlation is 1, you will get a straight line. You will get a straight line. Okay, because all the standard deviation is the weighting average. Okay, so you will get a straight line here. Okay, straight line here. But if the correlation is not 1, okay, it probably is a 0.9, 0.5. Okay, if the positive is near to the straight line, okay, and the negative number and the smaller number is more lower. Okay, so maybe I take this again. Okay, so just like I say, if the rho equal to 1, okay, you will get the curve is a straight line. It's a straight line. Okay, so all the standard deviation just based on the weighting average. Okay, weighting average. Okay, and if you have a -1, if rho is -1, and you can find you attach to 0. In fact, you attach to 0. It means if we have a -1 correlation, you can find a portfolio, and to make the risk or to make the standard deviation to be 0, or to be 0. Okay, so okay, so here we can see, just like I say here, this is based on the correlation. The coefficient is 1. Okay, so just like I say, you will find the point we're on a straight line. Okay, and if the coefficient is -1, okay, this is -1. Okay, so you will find I can rewrite the sigma square to be here. Okay, the w square sigma square minus 2 w1 w2 sigma 1 sigma 2. Okay, also use your junior high school mathematics skill. You will find we can rewrite the formula just like this one. And finally, you can get the standard deviation, the variance will be w1 sigma 1 minus w2 sigma 2 and square. Okay, and because here is negative, the upper one, this one is positive. So here is negative, So I'm pretty sure we can find a combination w1 and w2 to make this one to be 0. Okay, you can always find w1 satisfy and let the sigma square to be 0. Okay, to be 0. Okay, so because it's negative, okay, so you will find this is negative. So the sign is based on the correlation sign. Okay, if it's positive and here's positive, it's positive. Okay, and next we can see the coefficient is 0. If the coefficient is 0, okay, because this is coefficient is 0, this one is 0. I mean, this is 0, and we can just cross out this one. So you will see we only left about w1 square sigma 1 square plus w2 square sigma 2 square. Okay, so we only have w square and sigma square. Okay, and you can compare these two. Okay. Here is totally the same, just like here. Okay, so you can see here. So we are pretty sure this one is smaller. Is smaller compared to this one, or this one. Sorry. No, this one. Because this one, including here, the same, and add the other term here. And W1, W2, they are a proportion. We are not allowed short here. Okay, short, it means you can short some stock, you can short some financial asset, but we are not going to allow the short position. Okay, so all the W is positive. Okay, so this is positive, this is positive. And standard deviation is positive. Okay, because the standard deviation sigma is based on this. Okay. So it's kind of positive number. Okay. So we know compared to the coefficient is 0 and the coefficient is 1. Okay. Coefficient is 0 will be smaller. Here I compare at you have to compare at the same point. It means same W1, same W2. Okay, you cannot compare two different W1 and W2. Okay, so if in the based on the same point, the same W1 and W2, you will find, okay, coefficient 0, the standard deviation or the variance is smaller compared to the coefficient 1. Okay. Okay. So based on this, we know why we can use the diversification to reduce the risk. Okay, because based on the formula we know, okay, the risk will equal to their individual risk plus something. Okay, and the something including the correlation. Okay, so if the correlation is negative, and probably you have a chance to reduce the standard deviation or the variance. Okay, and next I'm going to give you another example here. Okay, suppose now you have two investments. The first one, you can put all your money on umbrella company. Okay, umbrella company that produce umbrella. Okay, and the other one, put all your money on golf course. Okay, they provide the course to the player. You can play the golf here. Okay, all the other one, 50-50. Okay, 50% money on umbrella company and 50% on golf course. Okay, and about the event, we just roughly assume we have two situations. Okay, rainy and sunny. Okay, if the rainy day is more than the sunny day, okay, and because rainy day is more, so you can sell many umbrella in the market. Okay, so you can earn 50%. Okay, if you just put all your money on the umbrella company. Okay, you can earn 50%. Okay, but if you put all your money on golf, and right, the rainy day is more than the sunny day. Okay, and most of people, they are not willing to play golf in the rainy day. Okay, so you are going to lose about 20%. Okay, and how about a sunny day? Okay, if sunny day, people don't need any umbrella. Okay, so you probably lost 20%. Okay, and you will put all your money on golf course. Okay, in this situation, you may earn 50% because the weather is good. So more and more people, they like to play golf. Okay, so they just walk into your golf course and to play golf. Okay, so probably you can earn 50%. Okay, so based on this, suppose the probability is 50-50. Okay, mean 50 rainy and 50 sunny. Okay, so you have 50% possibility you will be rainy day. Okay, and 50% maybe okay, it will be sunny day. Okay, so based on this, we can calculate the first one is expected return. Okay, so you will find 50%. Okay, here. Okay, 50. How to get this one? Okay, because we have 50% rainy. Okay, so rainy, when rainy, how much you can get? Based on, you just put all your money on umbrella company, 50%, you can get 50 if you put all your money. Okay, and but you also have 50%. You may lose. Whoop. Okay. Whoop. Okay, the first one, you have 50%. It's raining. Okay, when raining, you can get 50%. But we also have 50% sunny, 0.5. And when it's sunny and you put all your money on umbrella company, you may lose about 20%. 20%. Okay, so finally, based on this, you can get the expected return is 15%. 50%. Okay. And also based on the same rule, you can find the standard deviation, the risk is 35%. Okay, you can base on the previous formula to get the standard deviation. Okay, and how about if you put all your money on golf course? Okay, because in this case, we just design. It's a symmetry situation. We just assume the situation is 50, next 20, or next 20 and 50. Okay, and also 50%. So you will find it will be a very, very similar here. So you can see if we put all your money on golf course, you can also get 50%, 15%. Okay, the same because you have the 50% sunny, rainy. You start from rainy, and rainy you will lose 20%, minus 20%. And the other one also have 50%. It will be rainy, sunny. Sunny you can get 50%. 50%. Okay, so finally you can get the same expected return. Okay, and also the same standard deviation. Standard deviation. Okay, so based on this example, it means in this two investments, no matter you put your money, all your money on umbrella company or all your money on golf course, you can get the expected return about 15%, and the standard deviation is 30%. Totally the same. Totally the same. But here we just consider how about we just put all the not all the money in on single investment. Okay, we just consider, okay, now we just put 50% on umbrella company and 50% on golf course, And finally, you will find if you put 50%, 30%, okay, the first one, when the rainy, how much you can get? Okay, when rainy, your money on umbrella, you can get, because now it's 50%, you can get 50%. But the other one, you will lose 20%. So plus, okay, you still have 50% chance. You're going to lose about negative 20%. Okay, so based on this, you will find the first one, 25%. Plus, this is minus 10%. So finally, you can get the return is 15%. 15%. Okay, you can also get, okay, when the rainy, okay, rainy, On the umbrella company, you are lost 10%, 10%. Okay, because you only invest 50% money on the umbrella company. Okay, so 50% times minus 20%. So you are lost 10%. And also on the golf course, you will earn 25%. 25%. So 25% minus 10%, you can also get 15%. 15%. Okay. Then how about the expected return? Okay. Still based on the previous formula, based on the formula, you are fine. You are fine. Okay. The standard deviation will be 0. Will be 0. Okay. Because the expected return, okay, when you put 50-50 on the umbrella company and on golf course, okay, no matter it's rainy or sunny, you can always earn 15%. You can always earn 50%. Okay, so the expected return still 15%. Still 15%. Okay, I think it's just based on this is 50. Oops. This is 50%. This is 50%. Oh, sorry, 50%. And you just times this one, you can get this one. Okay, and the same rule, 15% times 50, 3%, and 15% times 50%. You can get, okay, the expected return is 15%. Okay, I think you don't have to make the calculation. You can find, because no matter it's rainy or sunny, both them are 15%. Okay, so 15%, 15%. So the expected return should be 15%. Okay, so the standard deviation should be 0. Okay, because we use standard deviation to measure the volatility. But in this case, do you have any volatility? No, because the return always 15, always 15, no matter it's rainy or it's sunny. Okay, you can always get the return is 15%, is 15%. So here we'll say, okay, the standard deviation is 0 or is 0. Okay. So this is an example you will find. Okay. Why, sorry. Why in this case we can get the standard deviation is 0? Okay. Because as you can see, the correlation is -1. It's -1. Okay, you can see because we just assume we only have two situations. Okay, one, the umbrella company earned 50. Okay, and the other one have to lose net 20. Okay, and the other one, okay, the golf course will earn 50, and the umbrella company will lose negative 20. Okay, so finally you can get the correlation is -1. Okay, if you calculate the correlation. Okay, if you like to know how to calculate the correlation coefficient, okay, you can also just check the statistic textbook. Okay, you can easy to find how to calculate. Okay, so based on this, we know the two investments had a -1 correlation. So you can easy to find, okay, if I use 50-50, and you can get an non-risky return, okay, and the standard deviation be 0, okay, and you can get a certain return. Okay, again, just like I say, okay, when we say you have the probability to earn 15% on rainy day and 20% negative loss 20% on sunny day, and expected 15%. The 15% it means for long term. Okay, maybe you just invest your money on the umbrella company for maybe 10 or 20 years, and after 20 years, and you calculate your average return, you will get the average return is about 15%, because after you invest, you put all your money on the umbrella company in the first year. Maybe you are unlucky. you unlock, you just meet a sunny day, like a sunny day. So you are going to lose 20% in the first year. First year is not get 15%. Okay, you just lost 20%. Okay, but in the next year, next year, maybe it's a rainy day. Okay, so you earn 50%. Okay, so based on these 2 years, first year minus 20, the second year plus 50. Okay, so normally if we calculate about the mean value, okay, maybe I can give you here. I just give you a easy, simple example here. Suppose we just observe 2 years. Okay, so maybe you are unlock first year, you just lost 20%. Okay, and in the second year, maybe you are luck, so you earn 15%. 10%. So based on these 2 years, normally you earn 30%. But this is for 2 years, so you just easy to get the mean value. Okay, normally we don't calculate like this one, but here I just give you a concept. Okay, so you can get 15%. Okay, so I think this makes sense. This makes sense because we say the probability is 50. So first one, next sunny day. Okay, the next year probably rainy day. Okay, it makes sense. It makes sense. Okay. But normally we are not just going to consider 2 years. Yeah, if you like to calculate the mean value, at least maybe 15 or 20 or 30 years. Okay.
Sorry, Professor, the time is 5 minutes left, maybe. Yeah.
Okay. Okay, maybe we just stop here. I just leave some time for students. And I'd like to know next week, because Professor Wadi already told me most of the students are the same. But I'm not sure. If they are the same, maybe we can start from here next week. How about this?
Okay, never mind.
Okay, so we just stop here today, and next Wednesday we can just continue from here. Okay. And the last time, maybe if students or have some question, we can discuss.
Okay. Yeah. Okay. Thank you so much, Professor Lee, for your explanation. I think it's very, very interesting topic about the understanding of the risk management, because when we talk about the risk management, I think it's very, very wide subject. So we can apply anything in all of the investment and in your maybe stock, bond, or maybe in banking as well. And maybe we can move to the next session, to the Q&A session. And I will invite to all the participants that would like to ask something about in risk management, about the investment, that maybe one of you that already have the experience in investment. I think it's better to share with us, and how to manage your risk, and how do you choose, for example, your securities, like the professor explained before. And okay, anyone here that have the question? Maybe you can raise hand using the raise hand tools in Zoom. Okay. Anyone here? Anyone here that maybe already experienced in investment, maybe in stock or maybe in bond? Yeah, I think because in the second years, in the fourth semesters, all of the students already thought about the investment management, professor, here.
Okay.
So I think it's very interesting topic, because maybe beside the the theory, we also have the practice, the real practice that the student must doing trading in the stock market.
Okay, okay, sure.
Yeah. Oh, okay. They have the question from Habib. They write in the Zoom chat about the question is the risk management in banking system, Professor, about the banking system.
Yeah, I already
Yeah.
I had read the question. Okay.
Yeah.
Yeah,
Do they
absolutely.
affect the economy? Yeah.
Okay,
Maybe
so in
you can directly,
okay.
to answer.
In fact, for all the banking system, okay, I think not just in Taiwan, but also in Indonesia, okay, the government, they just hope all of the bank, they can control their risk, okay. So I think, okay, especially in Taiwan, I'm not sure in Indonesia, in Taiwan, our government require all of the bank, they have to calculate about their, just like before we talking about the value at the risk, okay, because they like to require all of the banking system, they like provide the information, So, but it's not easy, I have to say, because value at risk, you need a big system, okay, because for a banking system, it including many different financial assets. Okay, so you have to calculate all the assets risk. Okay, and based on the risk, you can calculate the probability and about the loss. Okay, so especially in the bank, most of the bank is bigger. I think not just in Taiwan. Okay, most of the bank are a big enterprise. Okay, so if the bank have some risk problem, it's very serious. It's very serious. Okay, so if the bank cannot control the risk well, okay, it not just affect the bank, or not just affect about the investor. It also affect all the banking system. Okay, just like we know, maybe for the students, maybe you don't know, in 2007, okay, the financial tsunami from the US, okay, because the real estate market, okay, and in the beginning, just from the banking system, but finally it affect all, not just all the US, including the other countries, including Taiwan. I do believe maybe you also affect Indonesia, okay, because the bank, they will purchase many different financial assets from the system. Okay, so if you just buy some, maybe the garbage bond, and if maybe you can earn some money in the first few years, or later, okay, if you cannot control the risk, maybe you will lose a lot of money. Okay, so I think it affects the economy very serious. Okay, so this is why all the country, all the government, they just try to control the banking system's risk. Okay, they will require, for example, they will ask them, you have to provide capital ratio. It means because all the assets from liability and from the equity, okay, but from the equity, sometimes it's a short term. So they like to know how much capital are from the long-term resources, okay, especially from the shareholder, or how much money is from the long-term debt. Okay, so in Taiwan, the government will ask the bank, the capital ratio have to higher than a certain level. Okay, they cannot just issue bond or issue the stocks. Okay, because if you issue too much the liability, maybe you will face a default risk. The default risk will higher. Okay, so I think banking system more care about the risk management. Okay, so not just because it not just affect the single bank, it will affect all the system. If you are a traditional company, okay, traditional company, maybe you produce bicycle, that's fine. If you cannot control the capital ratio good, maybe you default, maybe you face some risk, and you will just affect a single firm. Normally, you will not affect other firm too much. Maybe you are upstream company, your downstream company, but just few companies. It doesn't like a bank system. Okay, a bank system is very, very big. Okay, not just that, just I say, it's not including the investor including the bondholder, the shareholder. You also including the depositor. Okay, you deposit your money in the bank, you affect you. So in fact, in Taiwan, we provide insurance deposit insurance. Okay, this is required by the government. It means in Taiwan, if your deposit no more than 3 million, you don't have to worry the bank default. Okay, under the 3 million, the company, the insurance company will pay you if the bank default. Okay, so I think this is a really good question. Okay, let's see.
Yeah, I agree with you, because in Indonesia as well, we have, so the banking sector is one of the high regulated institutions. So the government of Indonesia as well regulate the bank, like you said, about the requirement of the cash, like for the liquidity. So that's why, because Indonesia also had the experience in the financial crisis in 1998, that so many banks collapsed because the liquidity risk, and many customers withdraw their money from the bank, so the inflation is very high. So that's why it's very, very critical to the economy, I think. That's why. Okay. We have the second question also from the chat here.
Okay, so about any very specific steps in management. Okay.
For managing.
Talking about steps in management. The first one, you have to identify risk. Today we only discuss about financial risk, but in fact, not just financial risk. Financial risk just one. So the first one, you have to identify the risk, and the second one, measurement. Okay, measurement, maybe just like I say, you can use the VAR, value at risk. Okay, and based on this, you will know, okay, I have how much the probability I'm going to lose, how much. Okay, and can the company stand for the loss? Okay, for example, if it's small, if the loss is very small, maybe you can just ignore. You can ignore. Okay, if not, okay, in fact, you have some way. Okay, in fact, in our class, I already prepared some way in the later, but today we don't have time. So maybe we can introduce in next time how to manage about the risk. Okay, in fact, we have some way. Okay, just like today, for example, you just purchase a new car. Okay, and you are worried about someone stealing your car. Okay, and the easy way, you just go to purchase insurance. Okay, if someone steal your car, and the company, the insurance company will pay you. Okay, and you can transfer the risk to the insurance company. In the same way, in financial risk, we also have the same way. If you don't like the risk, you can transfer the risk to some entities. Okay, so in fact, I already prepared some to explain this part. Okay, and also next part is very important. Okay, maybe we can keep talking about after risk management and without management. Okay, which one is better? I think we have to have a correct concept. Risk management is just try to help you to find the risk, okay, and let you know where is the risk, okay, and also the second one provided you some method to reduce or to avoid the risk. Okay, but you have to remember one thing. Okay, when you like to reduce the risk, it costs. I mean, you have to pay something. It's not free. It's not free. Okay, just like you are afraid someone steal your car. Okay, and you purchase a insurance. You have to pay the premium. You have to pay the insurance premium. Okay, it means you have to pay some. Okay, to get the right. Okay, and the risk management also you have to pay some cost. So you have to consider when you, after you, because you have to pay something, and you can get something. Okay, and this is an easy economic problem. If the marginal cost higher than the marginal revenue, you just quit. Okay, if the revenue is higher than the cost, you just do it. Just do the measurement. Okay, so I think about how to do. Maybe I can show you next time some example. In fact, we don't have time to introduce everything, but just some. Okay, just let you know. Yeah, you can reduce the investment. You can reduce the risk. Okay, but reduce the risk not always good. I mean, you just try to reduce the risk, and sometimes when you reduce the risk, you will have to sacrifice some earning. You have to sacrifice some earning. Okay, so you have to base on the balance, which one's better. Okay, so I think next time I will go give the students some about how to do it, how to do it if you already know the risk. Okay.
Yeah. Okay. Thank you, Professor.
No problem.
Okay. I hope all of the question has been answered. And anyone? One more question, maybe.
Okay, I saw one about a digital bank.
Anyone here that maybe have the question?
Yeah, I already see one question. It asks about the digital bank.
Yeah, that's right.
Okay, and I think digital bank is very, very totally different. They were worried about the other risk, okay, because they use they just put all their transaction on internet. Okay, so their more risk is from internet. So they will care about not financial risk. Financial risk may be just like some other company or some other bank, but they have to care more about their system. Okay, so in fact, this part is not in financial risk. Okay, it's about operation risk. Okay, because maybe the risk the system before, if a system before, it may affect the transaction. Okay, it maybe you are lost your data. Okay, and all the transaction data may be lost. Okay, so they care more about the operation risk. Okay, so for this part, maybe because it's not covered in our topic. Okay, so I think if you're interested, maybe next time we can cover a little bit some other risk.
Yeah.
Because I in original I think we don't have enough time, so I just skip some other risk. I just put financial risk. Okay, but normally if we're talking about the risk, not just financial risk, also operation risk. Okay, operation risk is also important. Okay.
Okay. Thank you, Professor.
No problem.
Okay. Maybe I have this one question. This is the question from Pak Miftah, already my college in UMY, and actually Pak Miftah has been joined in the Zoom, but he has to leave because I have another business, and he has the question about maybe the portfolio management that you explained before, and the question is that maybe that some people that do not understand properly how to calculate the risk in the portfolio management, and maybe do you have suggestion maybe what the principle of the portfolio that management that maybe can follow for some investors, so they can at least can manage investment properly, especially regarding the risk management itself, Professor.
Okay. So today I just introduced some way to calculate about the risk, but I have to say, okay, here we just like try to convey some concept, okay, because based on those calculations, or I have to say the calculation are based on some hypothesis or the assumption. Okay, yeah. Sometimes we will assume the return is follow normal distribution. That's based on the normal distribution to calculate the variance or calculate the probability. But is the practical world is follow normal distribution? Maybe not. So here, maybe we have to say we just provide more about important concept. But when you like to apply those tools in your investment, you have to be very careful. Okay, because maybe in Taiwan we can find, okay, the return is follow normal distribution. Okay, but in Indonesia, maybe not. Maybe follow chi-square distribution. Okay, or just follow another distribution. So if you like to use those mathematical model to calculate, I will suggest you in the beginning, you have to check the assumption is matched to the market. Okay. Yeah. So even you use some maybe portfolio model. Yeah, I will always suggest you should check the data and the model first. If your model can match the data. Okay.
Okay. Yeah, that's great. Thank you so much.
No problem.
Okay. Maybe I think that might be all of you that still have the question, but you know that maybe we have the limit of the time, and already we have the 3 o'clock in Indonesia, I think, right?
Okay.
And maybe we can continue next week, right?
Yeah. Next week.
Next week.
Yeah. Okay. No problem.
Okay. Thank you, Professor Lee, for your explanation today. I think it's very great explanation about the risk management. So I hope that all of the students here get the more insight how to manage the risk, especially in investment, or maybe specifically maybe in banking. And thank you for all the students, and thank you as well for Ms. Retno Widowati.
Thank you so much, Dr. Lee.
Thank you.
And all of the lecturers that already come here as well. And for the close, the agenda today, let's we together say Alhamdulillah.
Alhamdulillah.
Okay. This is for me, and thank you very much. Good afternoon. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam. So, Dr. Lee, so the second will be 7th of July, right?
Next Wednesday?
Yeah.
Okay.
7th of July. And about at what time, the committee will contact you. Dr. Indah maybe will contact you the time. Sorry, the communication.
No problem.
Yeah, about the time. Yeah. Again, thank you. So also thank you to all the staff and participant students that are very enthusiastic to join this.
Okay, and also thank you all professors, and thank you all students, journalists. Thank you.
Thank you.
Thank you.
See you.
See you next week.
See you.
Professors, nice to meet you.
Thank you.
Yeah.